Hello guys, Gold Sniper here, bringing you a weekend learning video. Okay, and I believe this video will be very helpful to you guys. Okay, so today in the learning video, we are going to cover a concept called as a liquidity sweep. Okay, so what is a liquidity sweep? A liquidity sweep is where there is a large number of buy orders or buy orders or sell orders. Okay, where obvious places where this liquidity sweeps occur at obvious places where retail traders or small institutions place their stop losses. Okay, and what the big institutions do, they hunt their stop losses and then they reverse the price. But we need to understand, why do these big institutions have this place this hunt the stop losses. Okay, it is not because there is a reason behind it. Okay, now I will take an example for you guys to like to make you understand. Okay, let's say if you see this, this I have taken a section of the gold chart XAU USD to make you understand. If you see this, this looks like a a sort of like a head and shoulder pattern. Okay, so I'll just draw it for you guys over here again just to explain it. Okay, so if you will see, this can be considered as a this was a the right shoulder. Okay, overall pattern of the gold chart also, you see it is bullish only. This was the right shoulder, this was the right shoulder, this was the head of the pattern. Okay, and this was the left shoulder. Now what would most of us do when we see such a pattern? What will we will most likely do is buy around 1925. Stop loss will be the low somewhere around 1918, 1917, or 1920. Okay, and the people who bought here also would be placing the stop loss like around 1915 and stuff. Okay, so we what we would have done is buy for upside targets. Okay, but what happens is these when these big institutions, they want to make entry in the trend. Okay, what they do, they hunt the stop losses, they sweep the liquidity. Now if you'll see, in this pattern, most people stop loss, which range will it be? I'll mark that range where most obvious stop losses will be there. So for most people, the stop loss will be like somewhere between 1925 to like 1915, maybe even like 1913 also. So this basically, in this entire range, most people's stop losses will be there. Okay, so and you can see for a long time this region is not tested, so all these people who are placing stop losses are here. So there's a large amount of liquidity over here. Okay, large number of stop orders are over here. Now what happens is that, if you will see, if an institution, okay, let's say between 1930, okay, let's say 1935, I will take 1935 to 1925 range, I will take. So what happens, let's say between so okay, I made one mistake. 1934, yeah. So if I will take the range between like 1920 to 1935, let's say the current market price is around 1925. Okay, so 1925 I will take. So if a big institution, let's say there are there are 100 contracts are there, sell open contracts. That means 100 contract sell order is there at this price, 100 over here. This is just a hypothetical example to explain you. So this total, if you will see, at each level there are 100 open contracts. So if you want, if the price wants to grow from 1925 to 1935, okay, there are total 1100 contracts between 1925 and 1935. So each of these 1100 total this 1100 contracts need to be bought. Okay, so that this order, so that price can go to 1935. Now what happens is, there is very low liquidity over here. Okay, because for very big institutions with millions and billions of dollars, they do not buy such small quantity, 100 quantity, 1000 quantity. They are talking in terms of like 10,000 contracts, 100,000 contracts. Okay, so let's say this institution, this is 1100 contract, this institution wants to buy like say 2 to 3000 contracts. Okay, so what they will do, they know if they buy over here, okay, they won't get the correct price. So their average price, if you'll take the average of this, okay, that is coming around like the total is 21230. So 21, I'll just take a calculator. So 21230, and this is a 10 pip distance, so divided by, so 10. Hmm, something I'm getting wrong over here. uh, Anyways, you get my point. I'll explain you the average price. If you will understand, if there is 100 contract. Okay, I got it. What was the mistake? So the total number of contracts I've considered is 1100. So this total 21 230 we need to divide by 1100. Oh no 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 no. Calculator. Okay, so 21 230 if you divide by 1100 contracts, okay, you get an average of like just chuck it. Let's just say around 1930 is the average cost the institution is getting at. Okay, they want to enter this price at a very low cheap rate. So what they do basically, all these people who are long, okay, their stop losses are in the range of like, okay, one second, game is beginning. I need to go outside. Come on, damn you, close. Ah. Yeah. So yeah, I was saying, so most people, these those who are already holding the buy position, their stop loss is starting from the range, let's say from 1920 to like 1910, if I take the range. Okay, so between 1920 to 1910 there are, let's say, like this, all these, most of these, so that let's say like 200 I'll take. 200, 200. So all these prices, you see there are stop losses placed. Okay, for all these people who are long. Okay, so their stop losses are in the range of like 1920 to 1910. So what these big institutions, like I told you, they have like 10,000 order block, or very huge amounts of order quantity they have. What they will do is, they will hit all these stop losses, and at the same time, after hitting all their stop losses, they will buy. What happens when this sudden fall comes and every retailer stop loss hit, they are all their buy orders, when they are long and their stop loss get hit, it gets converted into sell orders. Okay, so these big institutions are getting at a very cheaper price, at 1920, 1919, 19, all this cheaper price they are getting the sell orders. Okay, and they are buying this sell orders simultaneously. They are absorbing all these, they are eating basically all the stop losses. And they also confuse the retail traders who think now the market has gone short. So further short positions are added by retail traders also in this position. So this is the time when they absorb all this quantity. Okay, they hit everyone's stop loss and then they reverse the market. So if you'll see, they get entry at a very cheap price. That's the end conclusion, and then they take the market up. So this is what is called a liquidity sweep. Okay, and the reason why this liquidity sweep is needed, so that markets can give a very big momentum, market can generate very big momentum. Markets cannot generate very big momentum if this liquidity sweeps do not happen. Okay, so that's why this liquidity sweep happens. Now I'll show you with a live example, so you will understand. Okay, so for that I'll go to go charting. Okay, here I have this chart of like XAU USD. Okay, here you can just rewind the chart and see also. So here I go, and yeah, so I will just use the rewind feature of XAU USD. Okay, so this, I was showing you over here, guys. Okay, see, this was the liquidity sweep. Okay, this is how the liquidity was taken out. This is in 15 minutes, but I'll show you how it looks live. Okay, so this is the rewind feature I'm using. Okay, so here the price was, as you can see, before this, this liquidity sweep over here. So I'll just play it in slow so you can see. Just give me a second. 1 second. Yeah, so we will play. Now you just watch the chart. Okay. So now if a retail trader will see, he is seeing like a head and shoulder pattern, and yeah, now the price is becoming bullish and all that, he will think. Okay, but then here comes the play by the big players. Okay, it will come now. See, first it's a big they take a spike up move. They absorb the liquidity over, see, this spike which you see over here, this is basically they are absorbing the liquidity sweep they are doing. They hit the stop loss, all the people who are sell, who have sold somewhere here or here expecting the price to go down. So they hit you, they absorbed their order, and then price makes a sharp down move. You see now it will happen, the down move. See, the liquidity was swept over here, and now the down move should begin. See. Here, right here, you see the stop losses. All those people who long there, ideally their stop losses are getting hit. Okay, so people even here also were not spared. Okay, but remember these people when they hit the stop losses, okay, they will not bring it to such a down extent that it changes the trend in the longer time frame. We need to see the trend in the longer time frame to identify where the support is. Now we'll continue the play. Okay, see. See, they hit everybody's stop loss. Okay, and when this type of wick sort of candle is forming now, okay, this is a sign of reversal, but we need to wait. Okay, we do not enter the trade now. Okay, now a whole lot of people will. I'll tell you once again. See, now a whole lot of people will think that the trend has become bearish. Okay, after hitting the stop losses, okay, they all the buy order, all the sell orders will be when it was being executed, the big players were started buying. That's why you see this sort of formation. Okay, and when this green candle is formed, a whole lot of retailers will think now this is a pullback, and again you can short it from here. Okay, but what happens is the exact opposite. Now the big institutions strike. Now they have swept the liquidity. They have entered at very cheap prices. Now they will take the price upwards, and you can see the boom, 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 boom. See, so when we were all shorting, these guys, these bastards started making money. Okay, they fooled us, and then you see they have reversed the market entirely. After that, gold consolidates and then again goes up. Okay, so this was such a good move. So when you get hit by such liquidity sweeps, okay, the way to enter the re-enter this trend is to look for a confirmation on the lower time frame that the chart structure has changed. So if you see the chart structure, I'll show it on this investing.com. For this you need to use the smaller time frame. So let's say 5 minutes is too big. Even this happens very quickly, so that's why a 1 minute time frame will be better. So I need to go seriously backwards to show you this move. Okay, it happened somewhere around here. Yeah, this was the move. Okay, so now if you will see in 1 minute, this can also be seen in 3 minutes. So if you see the structure was lower low, lower low, lower low. Okay, after hitting everyone's stop loss, we wait. Okay, let it come make a breakout above a major support. Okay, and let its structure change. When I say its structure change, let it make a higher low above a major support. So if you will see over here, okay, so from here its nature changed. It started making a higher low over here. Okay, when this gave a pullback, and then this you know price went up, this was the entry point. Stop loss should have been the low of this candle, and you can see the target, such good targets it gave. Okay, very good risk to reward ratio target. Okay, so this is my point. Okay, this is what happens. This is this example which I gave you. This was a bearish liquidity sweep. The reverse happens, okay, when price goes up, hits the liquidity on the upside and then comes down. Okay, and or sometimes it goes down, hits the liquidity and comes up. So the reverse example of liquidity sweep, that also I will show you guys. Okay, that is I'll show you. I want a good example so that I can explain you guys. See, here was the example. You see this? Okay, here most people, if you will see, okay, the trend, if you'll see, it was overall bullish trend only. Okay, if you will see the little bit longer chart structure, I'll show you. So here this is a great example. I'll just mark it so I know where to watch. Okay, now we'll go on the smaller time frame. Where is it? I can't see that box. Just give me a second. I'm trying to find it. Uh, can't find that box. There is some chart missing also over here. I think maybe some server maintenance is going. Anyways, it's okay if we can't see that. No problem. But I'm main thing is that I hope you got the point which I'm trying to convey. Okay. If you will see in hourly also, this was a liquidity sweep over here. Okay, this was done. That basically whole lot of people, their stop losses were hit. Okay, those were on the sell side, and then the price came down. So that's what I wanted to point out to you guys, and this was the video I wanted to share with you guys. And in this happens mostly in the New York session. Okay, and when London and New York session are running together, this kind of move happens. Okay, so that was the learning video I wanted to share with you guys. uh, Thank you, and let's see tomorrow what happens then. Okay, then bye.